Dennis, it's good to have you back on again. Great to chat. If you were still sitting there in that room, would you have voted on no rate hikes to 2023?
Well, yes, I think I would have. There are a couple things on their minds. Obviously, the employment situation, which Jay Powell talked about quite a bit. And at the same time, I took away the emphasis on inflation expectations, and changing inflation expectations takes some time to ensure that they're really anchored. So the 2023 for liftoff seems to me realistic. The other interesting question is tapering of the bond purchases, and he did signal that they've begun to discuss that.
Yeah, and there's a lot to unpack there, Dennis. And let's start with the second part first and talk about the taper, because the market, by the way, we've already started a taper just on the corporate bond side, much smaller. The government bonds is what they really do care about. But
those, Brian, those were emergency actions. So they're really unrelated to the monetary policy. Yeah.
Yeah, but they did hold them, and now they're sort of unwinding them. There's a lot of acronyms, like in 2008. I'm just trying to make like the SNCF and trying to make sure that our audience understands all the different stuff, because we already had to learn enough about 10 years ago, Dennis. When we talk about a taper, is one of the reasons we're looking out to 2023 because to taper a balance sheet of that size will take a long time. I mean, could it take a year or more? And so we can't raise rates because that process is just going to be a long, slow-moving train.
Well, first, I think they will taper before liftoff. I think that sequence is logical, and so the first action to remove accommodation will be the tapering. How they will actually conduct that remains to be seen. Judging from history from the last time we went through this, in all likelihood, they will slow purchases. They won't just go cold turkey and stop purchases. And yes, it could take some time. It could take arguably, a matter of a few years to get back to something that looks like the balance sheet pre-COVID.
Yeah, and that's what's interesting too. And let me ask you this, job market, Dennis. I know we've been conditioned that low rates are good, higher rates bad. But if you're a business trying to operate and low rates are sparking inflation and everyone, you can't get workers, and if you can, you have to pay them so much that there's no way you could raise prices enough to actually make any money, so why be in business? Is there any chance that the low rate policy could actually damage the Fed's mandate of maximizing employment? Or do you think that would have no impact whatsoever?
I view this pretty simplistically, and I think you stated it. You stated the logic correctly, and that is low rates on balance are better for stimulating the economy to get people back to work than higher rates. And to me, it's about that simple.
Yeah, because we want to maximize employment. We want to do that by stimulating economic growth. We had an artificial drop due to the pandemic and lockdowns, then a rapid fire return. I guess the question is, if you're in that room, what do you think Jay Powell is thinking about when he looks at a job market that's still, by the way, coming back strong, but also has, 7 or 8 million open jobs in America right now?
Well, I think they have very much front of mind, the whole committee, the conditions pre-COVID. And if you think about that, we had participation that was in the 63 to 64 range. Today, it's in the high 61 range. So there's a gap in terms of participation. And then secondly, 3.5% unemployment with that level of participation. Today, there's, as he said, there's a long way to go to return to that world. And so I think that's what they're thinking. They're thinking we want to restore the very good conditions in the labor markets, the employment markets that we had pre-COVID.
What do you think the next big change is going to be, and where might it come from? Is it going to be the Jackson Hole Symposium in August, that beautiful setting in Wyoming always kind of tends to be where we get some new Fed news, or do you think it will be later than that when another sort of a big shift, Fed style, of course, may happen?
Well, the big shift, of course, will be around tapering, and it will be some concrete information about tapering, so the markets will understand how it's going to be carried out and what the mix of assets would be. It could be mortgage backs that to start, or it could be balanced between mortgage backs and treasuries. Since they began the discussion at the meeting that ended yesterday, I think the Jackson Hole Conference would be an occasion for Jay Powell to kind of lay out a plan and to really flesh out the thinking for the public. That might be a little early, but the timeline that I kind of believe will take place is either Jackson Hole or September. We will get a lot more new information as to how it will be done. And then it will be a few months before they begin to implement the tapering itself.
Shepard Smith here. Thanks for watching CNBC on YouTube.